It's on deck with Anchor, and today we'll be talking about 3 products: bank accounts, wallets, and virtual accounts. What is the difference? I have Shegun with me here. Hi, Shegun.
Hi, Star.
Okay, great. So, with the growth of fintech in Nigeria, Africa, and globally, so there are a lot of products that people confuse the definition. So I want you, in this context, I want us to talk about wallets, bank accounts, and virtual accounts. So what's the difference between these 3? Can you talk to us?
Yeah, thank you. It's understandable why people would use those things interchangeably because they have some similarities, but they are definitely different, like you rightly mentioned. The first thing is bank accounts. So bank accounts are the traditional deposit accounts that people are used to. They are issued by a bank, ideally.
Traditional bank or any bank?
You have to be licensed, a licensed bank.
Okay.
So either it's mortgage bank, commercial bank, microfinance bank. A bank account is typically issued by a licensed financial institution.
Great.
As a store of value to manage your money and all of that. And that is the one that for the longest time all of us are used to. When you walk into a traditional bank, a branch, and you want to open an account, what you open is an account.
Okay.
So it exists on their own system. That system is called the core banking systems. That account is insured by the NDIC, which is the
NDIC?
Nigeria Deposit Insurance Commission.
Okay.
They insure all the deposits in all the bank accounts that exist in all the banks today.
Okay.
So that is the traditional one, and that is more like the parent of all of these other types of accounts.
Okay.
So typically, for you to open a bank account, the KYC is know your customer. That's the information that will be required from you will be significant. It will be slightly a lot more than these other ones, and I'll get to that. So that is for bank accounts.
Okay.
For wallets are basically a store of value as well.
Okay.
But they may or may not be issued by a bank.
Okay.
So it's not only banks that can issue wallets.
Okay.
So telcos can issue wallets, mobile money players can issue wallets, fintechs can issue wallets. So a lot of what people issue today as a way to transact are actually digital wallets. So it is also a store of value, but the idea behind it is that for people who might not have the documentation and the resources to actually create a proper bank account, they can access a wallet because the KYC requirement is lower. So for wallets, you can open it with something as simple as if you can have a phone number, you can have a wallet.
Just a phone number.
The minimum requirement to open a phone, to get a phone number, so your name, your passport, basic things that most people would have.
Yeah.
So there's no requirement to validate your address and all of those things that will be required for a bank account.
Regular bank
exactly.
account. Okay.
So the idea is that for people that want to get introduced into the financial system, it creates access for those people to get started, and as they mature in the financial space, they can hopefully then actually have proper bank accounts.
Give me an example of a wallet.
So most of the fintechs in Nigeria today actually issue wallet, apart from the ones that are actual banks. The account that they give to you is actually a digital wallet.
It's not a virtual account.
But it is not a bank account. It is a wallet. And I'm going to get to virtual accounts.
Okay, that's
so virtual account is a type of account that is mostly meant for single or temporal use.
Okay.
So it is not meant to serve as a long-term store of value. That's the core difference between virtual account, wallet, and bank account.
Okay.
The virtual account is more of a transactional account, not a store of value. So
it can be a one-off.
Exactly. That's why you see there's a lot of this dynamic virtual account use cases where you want to make a payment one time.
It just gives you a number
an account
to pay.
number is generated, exactly. So typically they're actually virtual account numbers.
Okay.
They're basically generated, they don't sit in the core banking systems of the bank.
Okay.
They are generated and tied to a particular account. So for a virtual account to exist, there has to be a proper bank account.
Okay.
So every virtual account you see today is tied to either an individual or a corporate, some form of actual bank account. But they have some functionalities of a bank account whereby you can use it to receive and do basic transactions, temporal transactions, and the funds that flow through a virtual account will still at the end of the day settle into a proper bank account.
Oh,
so virtual account numbers can actually be used for both digital wallets and for actual deposit accounts because they cannot stand on their own.
So they're like conduits.
Exactly, that's the word. They are conduits for transacting into a proper store of value, and they are typically temporal in nature. And funds that are transacted through virtual account numbers are obviously not insured because in quotes, it is actually not an account that exists at the core infrastructure of the bank. So that's really the difference between a bank account, wallet, and virtual accounts.
That's actually interesting. So let me try and break it down for people listening. So a wallet is issued by most fintechs, right? Well, not just fintech companies, you know, just a store of value. So it doesn't have to be tied to a bank account, right? A bank account is issued by financial institution, licensed, and is typically insured by the NDIC, right? And the virtual accounts are conduits, sometimes one-time use or temporal, and it's the money in the account, it will actually be sent to a proper bank account.
Yes, that's some summary.
That's brilliant. Thank you, Segun, for that insight. That's it on today's episode of On Deck with Anchor. We'll see you next time. Bye.